Have you ever wondered how large corporations decide if a major investment, like building a new factory or acquiring another company, is financially sound? They need a reliable benchmark to measure the minimum acceptable return. At the heart of this financial evaluation is the weighted average cost of capital, or WACC. WACC represents the average rate of return a company expects to pay to finance its assets. Essentially, it is the cost of every dollar a company uses to fund its operations and growth, averaged across all sources of capital, including both debt and equity. The core components of WACC are the cost of equity and the after-tax cost of debt, each weighted by its proportion in the company's capital structure. The cost of equity is the return required by shareholders for their investment in the company, reflecting the risk they undertake. This is often estimated using financial models like the Capital Asset Pricing Model, or CAPM. The cost of debt, on the other hand, is the interest rate a company pays on its borrowings, adjusted because interest expenses are typically tax-deductible, which provides a tax shield. The weighting factor for each component is crucial and is based on the current market value of that capital source, not its historical book value. To determine the cost of equity using CAPM, you need to estimate the risk-free rate, the market risk premium, and the company's beta. The risk-free rate is usually the yield on a long-term government bond, while the market risk premium is the expected return of the market above the risk-free rate. Beta measures the stock's volatility relative to the overall market. For the cost of debt, you can look at the yield to maturity on the company's outstanding bonds or the interest rates on its term loans. Then, you multiply this pre-tax cost of debt by 1 minus the company's effective tax rate to get the after-tax cost. Finally, the market values of equity and debt are calculated by multiplying shares outstanding by the current stock price for equity, and by summing the market values of all debt instruments for debt. An insightful detail about WACC is its dynamic nature. It is a forward-looking measure, highly sensitive to prevailing market conditions, investor sentiment, and the company's specific risk profile. This makes WACC not just a calculation, but a critical input for capital budgeting decisions, often serving as the discount rate in discounted cash flow valuation models. It also acts as the hurdle rate that new projects must surpass to be considered value-adding. By diligently understanding and calculating its WACC, a company gains a powerful tool to evaluate investment opportunities and allocate capital effectively. This process helps ensure that a company only invests in projects that are expected to generate returns greater than the cost of funding those projects, thereby maximizing shareholder value and fostering sustainable long-term growth.